As markets chop in an environment defined by high-stakes diplomacy, central bank decisions, and algorithm-driven positioning, investors find themselves between optimism and caution. Last week's symbolic US-UK trade deal and Britain's rate cut have given way to the looming US-China tariff talks in Switzerland and President Trump's ambitious mission to secure Gulf sovereign fund investments. Against this backdrop, the S&P 500 and Germany's DAX have chopped within tight technical ranges, while volatility measures signal a temporary calm before Friday's options expiry. In the following video, we'll explore how these intertwined geopolitical, fundamental, and mechanical forces are shaping today's market rally, and what will it take for this corrective rally to evolve into a sustained bull market. I'm Ivo, Delta Stock's Chief Market Analyst. Let's get to it. Okay, so Thursday's announcement of a full and comprehensive, that's quoted, US-UK trade deal, while largely symbolic given America's existing surplus with Britain, set the tone for the week, which was defined by cautious optimism and tight technical ranges. Even as sterling wavered on the Bank of England's 25 basis point rate cut to 4.25%, markets were quick to pivot towards what lies ahead, which is the high-stakes US-China negotiations in Switzerland and, of course, President Trump's forthcoming tour of the Gulf, which seeks to gather about 1.4 trillion in sovereign fund investments. Despite these headlines, the S&P 500 has spent past week oscillating between a remarkably narrow band, which is between 5560 and 5700. And this is indicative of the tension between positive narratives and the lingering uncertainty. On one hand, reports that the US may slash tariffs on Chinese imports from 140% to roughly 54% have definitely intrigued investors and are suggesting a genuine willingness to compromise ahead of talks. On the other hand, the index remains nearly 8% below its all-time high and has yet to clear its 100-day exponential moving average, and this is a major technical hurdle which signals that much of the good news may have already been priced in. At the same time, Germany's DAX has staged 4 tests of its all-time high, which is around 24,000, and each attempt heightens the odds of a breakout. Traders have been targeting the 24,200, yet the fact that the DAX keep pulling back suggests that the easy part of the rally is behind us and that responsible position sizing is more important than ever. Meanwhile, volatility expectations have been recalibrated, the VIX term structure has flipped back into contango, and traders seem to be shorting it, and this all points to the traders' belief in continued calm, or at least further volatility compression, at least to through Friday's OPEX. Beyond technicals, geopolitical developments continue to be on the agenda. President Trump's trip to the Middle East is more than just optics. It aims to cement a $100 billion arms deal and unlock fresh trillions from the Gulf sovereign wealth funds into US tech and semiconductor sectors. And while these potential inflows could deliver a powerful liquidity boost, Gulf investors remain wary of the US inflationary pressures and policy risk. Only a concrete, bankable commitment will convince them to deploy capital in the scale Trump seeks. Credit markets have also responded to trade optimism by tightening the UK and US spreads, yet bond yields tell a bit more cautious story. Fixed income investors continue to price in significant tail risks that equities have so far shrugged off. This disparity underscores the strategic use of bullish rhetoric from the White House with comments like, "Go out and buy stocks now," which is actually a comment from Trump. This disparity underscores the rather strategic use of bullish rhetoric from the White House with comments like, "Go out and buy stocks," which is actually a comment from Trump, and these are designed to trigger algorithmic buying, but high frequency systems remain sensitive to any wave of disappointment. So basically, the path to a genuine bull market where rising prices characterize the trend rather than mere corrective rallies hinges on three concrete developments. First, the formal investment commitments from Gulf states that would inject fresh institutional demand. Second, a signed, enforceable trade accord with China and ideally other major partners. And third, progress towards a peace framework in Ukraine, which would alleviate geopolitical premium across energy, defense, and agricultural sectors. Without such milestones, rallies, however mechanically supported by algos, remain very vulnerable to reversal. And for now, what I expect is some range-bound trading to persist into OPEX, which is this Friday, with a potential shakeout should Saturday's China talks falter. Once those negotiations conclude and Trump's Gulf tour unfolds, we'll have a clearer picture whether this market can finally shake off the bear market rally, which is the current label it has, and embark on a sustainable uptrend. Until then, the interplay of headlines, technical thresholds, and algorithmic positioning will continue to define the delicate balance between optimism and caution. Let's get to the major economic events this week. On Monday, we have a couple of USB auctions you need to be wary of. We have a lot of data on Tuesday. With the main one is the US CPI, employment data from the UK, and a couple of zoo surveys from Europe. On Wednesday, we'll see the German CPI. Thursday brings UK GDP and other economic data, the focus being on Jerome Powell's speech and the initial jobless claims for the US. Of course, we have some retail sales we'll be watching for. And Friday has US consumer inflation expectations and Fed's daily speech. In terms of earnings, it's a rather calm week with the focus being on Walmart, Tencent, and CoreWeave. That's it for this week's video. Like and subscribe, and see you next week.